and welcome the speaker with a floral bouquet. Thank you, Chairman, sir. I have privilege in introducing our speaker, C.A. Nithin Surana A, ACLLB, BCom. C.A. Nithin Surana is a chartered accountant and partner at Marlecha Surana and Associate, Bangalore. Nithin has previously worked at HC Kincha and Associate and JCSS with special focus in the areas of direct tax consultancy, litigation matters, transfer pricing, and international taxation. With over 8 years of post-qualification experience, he has worked on an assignment involving a range of domestic and international taxation and regulatory issues, litigation and consultancy services to the various entities, including listed multinational companies as well as high net worth individuals. He has presented clients before various income tax forum and tribunals. Nithin has also delivered lectures at a study circle on income tax topics at a various institutions, ICI, and income tax forum. With this brief introduction, I welcome you, sir. Over to you. Thank you.
Thank you for taking time out on a Saturday for this. So we'll begin the session. So the topic probably that we are going to discuss right now will be exemptions other than trusts under the Income Tax Act 2025. Just on a lighter note before we begin, the topic for the 4 sessions that have been scheduled for the next couple of weeks, the topic for the sessions is demystifying the Income Tax Act 2025. So when the finance minister gave out the speech and all the other media outlets saying that the Income Tax Act has been simplified. So the first thought that hits my head is, why is it called demystifying the Income Tax Act? It's already mystified. So then once you start reading, you feel, I think so, people who've named the session have definitely thought about it and that it requires demystification. So therefore, but the premise we'll have to begin with is that what was there before is there now, because that is the underlying intent with which the government has begun this. If we then start nitpicking into words, then we might lose track of what they really intend to do. So we will proceed with the session today, assuming that everything which is in the old act, all the principles, all the judicial precedents continue now. But again, when you go through these sections today, there is not much value add if we don't get into what they could have done versus what they have done. So I will go into slightly matters which they could have done to probably simplify it a lot more and achieve their intent of reducing litigation as well as simplifying the law. So we'll just begin with the agenda for today. I've just laid out the agenda very briefly. We'll just touch upon the intent of why the act was coming very briefly. I think a lot of the speakers who've probably spoken before me have touched upon this, but we'll just probably take a couple of seconds on this and then move ahead. Then we'll go into introduction, the layout of how the exemptions have been placed in this act, which are slightly different to what was there earlier. Then there are 6 schedules which deal with exemptions in the current act. So we'll just go through all these schedules one by one. I will not focus a lot on sections which probably have not undergone a lot of change, or which have remained the same mutandis in the old law as well as the new law. So we will try to focus on things where there is something to discuss and probably we can take home something from that discussion. So we'll probably focus more on those clauses and sections, and just we'll touch upon a certain transitional provisions which ideally should have been there in the current act. This is something which is going to be handled by esteemed speakers in the coming weeks, but I will just touch upon it. So, probably you have some sort of a recovery when you start the next session. So we'll end with that. So we'll just begin. The first, we'll begin with intent of why the Income Tax Act 25 was brought in. I think all of us are more or less well versed as to why this was gotten. A lot of statistics have come out from the side of the government, plus a lot of media houses also have been doing this. So basically, just to reiterate what the finance minister announced, that the purpose was to make the act concise, lucid, easy to read and understand, thereby reducing disputes and litigation, thereby providing tax certainty to taxpayers. I think the intent which they have started is definitely seen in the new act. But as we just read, I think we will find a few places here and there, probably tiredness while drafting or something, a few places they have missed out, which we will just touch upon. And then, but we'll still have to take it with the intent that, no, this was the intent before, we will continue to keep it. That's how we will go. So the need for the new act, why did it even arise? It has been amended nearly 65 times with more than 4,000 amendments over 6 decades. So this is a very old law. They felt that it had become bulky, a lot of judicial precedents, a lot of circulars, a lot of notifications. They've tried their best to crunch everything into the act right now. Then extensive amendments, numerous exemptions, deductions, traditional legal structure, fragmented structure, outdated provisions. So I think there are a lot of bits and pieces all over the act which required connection under the old law. They've tried their best to culminate everything, put everything into tables or provide predefined formulas, and actually have made an effort to make it more user-friendly or reader-friendly, which we will see when we go ahead. Like I started the session with a precursor that we have to keep the contextual background of the 1961 Act when we step into 2025 Act. Or else we will be doing an exercise altogether again, which is not required ideally. So the press release stated that they have followed these principles. Basically, the textual and structural simplification for improved clarity and coherence, no major tax policy changes to ensure continuity and certainty. So they made sure they don't do anything drastic. Then no modifications of tax rates, preserving predictability for taxpayers. So basically, they want to make sure when we move from 61 to 25, there is not much gap. The readers of the act plus the people who are applying the act, all of them do not face any problems in, let's say, applying the provisions. In essence, the act is designed not to overhaul tax rates, but it is to overhaul the tax experience, making it more predictable, efficient, and digitally enabled. Now, just an introduction and a layout out as to how these exemptions have been placed in the act. They continue to be in Chapter 3 of the Income Tax Act. It was earlier in Chapter 3 of the 1961 Act. So that remains the same. The heading of the chapter also remains the same. It's still income which do not part form of total income. That's how it is. The section number, however, has changed. It's because the Act got an upgrade, even Section 10 got an upgrade, it became 11. So 10 has become 11 now. All the erstwhile subsections, save some deletions, have been moved to schedules, maybe 2 to 6. So what was basically 50 subsections with multiple sub-clauses, sub-explanations, all that has been moved to a concise table now. So just giving an outline, there is schedule 2, 3, 4, 5, 6. 2 is the general schedule, which deals with incomes which are not to be included in the total income. 3 deals with exemptions for certain persons. 4 has, they have bucketed this basically, 4 is for non-residents. 5 is for investment funds, business trusts, their unit holders. 6 is specifically for IFSC. So they have made sure that everything is not jumbled up. You don't have to go from 1 to then 40 and then come back to 12. So everything is there. Now, so we'll begin with the verbatim of Section 11. So verbatim of Section 11 is on your screens. So it says, in computing the total income of any person for a tax year under this Act, any income enumerated in Schedules 2, 3, 4, 5, and 6 shall not be included subject to fulfillment of conditions specified therein. Now coming to 2, now it is, I think anybody reading clause 1 will say what does not fall under 12 then definitely has to become taxable under the Act. But then they have become, I think, extremely conservative and gone ahead one more step and said, wherever the conditions referred to in 1 are not satisfied in any tax year, in respect of any income enumerated in the said schedules, such income tax shall be charged to tax under this Act on the total income for the tax year. Now, I will read the last sentence again. It's highlighted in blue, or it's highlighted. It says, such income shall be charged to tax under this Act on the total income for that tax year. So it says income to be charged to tax again on total income. So basically there, I feel that the words on the total income is superfluous, not required. They could have just stated such income shall be charged to tax under this act for that tax year. So basically I feel there's a duplication not required, probably can create some confusion going ahead. If you come down, this becomes more clear, because when you read 4 and you read the highlighted sections there, it says shall be charged to tax under the provisions of this act for that year. They could have used the very same language for 2 as well. But they've gone ahead and used such income shall be charged to tax under this act again on the total income for that year. Probably on the total income was not required there. Then coming to 5th, it's a saving clause to remove difficulties, which they have not stated. But the central government may make rules or issue notifications for the purpose of this section as specified in schedules 2, 3, 4, 5, 6, and 7. Now, like I said, 11.2 deals with circumstances where conditions referred to are not satisfied. It concludes with such income being charged to tax on the total income for that year. It's practically difficult to give effect to this. Like I said, probably on total income is not required there. And the language of subsection 4 could have been used in 2 to just make things simpler. But one question that remains with me and probably needs to be answered is, as incomes have been moved to schedules now, can CBDT pass or amend rules or notification without parliament approval? Because neither have they used no use of words for removal of difficulties, because every saving clause in every section generally uses the words for removal of difficulties. When we go ahead, we will see that some subsections or the clauses under 10 have used for removal of difficulties very clearly. But here 11 has not used for removal of difficulties at all. They merely said that we are going to issue notifications or amend 3, 4, 5 whenever required. But then again, I think there's sufficient safeguard already there with our judicial precedents, which state that any amendment cannot be made in a notification just by passing a notification or circular. It has to be through the parliament, placed in front of both houses, and only passed, and only then it can be done. A similar circumstance had come to fore earlier, when in 1966 a notification was passed extending the time limit to sell attached properties. They did it through an amendment. This traveled to the Supreme Court, where the Supreme Court said this is ultra vires, you can't do this. You have to pass it through an amendment. So the fear that they might do something by not putting it through the process of law is not possible, even though the words don't say that. But probably this is not going to happen, and public consultation and parliament consultation is going to happen before this. Now, so my attempt has been to put in serial numbers. So basically, because these have moved to schedules now, there is no section number as such or a clause number. Everything is a serial number now, and every schedule starts with 1. So there is no continuity saying when we go to 2, 3, 4, 5, 6, 7 that the numbers continue. It's not numerological. So as the schedule ends, the next schedule starts with 1 again. So that's how it's placed. And I've tried to give a reference to the current act just for some recall value and what kind of income it is dealing with. And like I started, that if we go ahead with only the premise that nothing has changed, then we might not take home anything today. So we will try to see what could have been improved or what still remains an issue, even though the intent is to reduce litigation or make it simpler. Is there something still there which can cause problems? Or they have just merely taken up an exercise to just reduce the number of words and not really address the litigation portion of it or make it more user friendly. So we'll go with 1. So 1, basically schedule 2, serial number 1 and 10.1 are congruous. So it deals with agricultural income. Now there were certain issues earlier relating to constitutional validity. Can this even be there in the act because it has been exempted by the constitution itself? Agricultural income cannot be taxed. But then this has traveled to the Supreme Court. The Supreme Court is saying there is no tax as such on agricultural income. We're only including the agricultural income for computation of taxes. So therefore, if there is any challenge again under the new act saying this is not constitutionally valid, might not hold good, because multiple high courts and even the Supreme Court has a chance to get into this by saying that we're only included for the sake of computation. But one might put up an argument that after doing the adjustment, sometimes the taxes payable are slightly higher after including the agricultural income than before. So there is an incremental taxes, but I think the courts have gone into this aspect, and this already been dealt with. Any person earning such income is exempted from tax. For instance, any person with business income also. So basically, it cannot be a ground rule that just because I am doing some other sort of business and I am getting an agricultural business on the side, you cannot say that I will not be eligible to exemption. By the very constitution, agricultural income has been exempted and it will never enter the total income. So you might have other sources of income, but your agricultural income will continue to be exempt. Now, this has come up multiple times before Supreme Courts, I think through the years, that let's say a company is in the business of agriculture, so basically its income is exempt. So can the taxpayer receiving income from that company in terms of dividend, can it then say that because the company where I am a shareholder, basically I am the owner of the company, can the shareholder then take a stance that you are giving me agricultural income, even I am not going to pay any taxes on it? Because it was exempt there, it is exempt in my hands. Now, this has come up in front of courts a number of times, right from 1970s to as recent as 2017. The first decision started with Bachaev Guzdar versus Commissioner of Income Tax. Then it moved to Godrej Boys Manufacturing, that is 394 ITR 449. It also came up in Tata Tea Company Limited, where it says what the company is paying taxes are on the income which is computed. The shareholder merely has a right in removing that money. The income or the color of the income will not remain the same. It is only agricultural income for the company and not in the hands of the shareholder. Further, what is paid to the shareholders is dividend, which is specifically being defined in the Act itself. So what the shareholder is receiving is dividend and not agricultural income. So that is how courts have gone and interpreted this section. And therefore, if somebody is to take up this argument today that because I am the owner of the company, the company is earning agricultural income, even that is going to be exempt in my hands, will not hold good. The next section is serial number 2. It deals with 1010D, which is basically life insurance, ULIPs. ULIPs now has seen a couple of amendments in the last couple of years. They have increased the limits and they have tried to kind of thwart attempts which high net worth individuals are using, where they're pushing in a lot of money and trying to remove a lot of fixed income, which is high interest rates backed by our government, which is quite high according to them, and this cannot be misused. These sections have been created for the common man, so they have put ceiling limits. So there are a couple of issues that arise in 1010D. Now, if we read the section, so I think if we can I'll just go back, just quickly read through what 1010 is saying. Actually, I think this has been circulated. I'm not sure, but anyways, we'll just go through it. So second one says any sum received under a life insurance policy, including the sum allocated by on such policies. Now these policies will be exempt if the following conditions are satisfied. These are already prevalent in the old law. Just continuing, this has been put into a table for easy understanding. It says from the year 2003 to 12, that is April to March, if the sum assured was 20% of the policy, it is going to be exempt. From 12 to 13, this was again reduced. It has become 10% now. So between this period, they said any premium which is in excess of 10% of the sum assured, we will not give an exemption. Then from 13 to 21, they introduced another category for special person, that is basically for anybody with a disability. They said 15% of the special policy will allow the sum assured to be that. Anything exceeding 15% we will tax, and the 10% continued for other policies. Now, from Feb 21 to 23, this is the new introduction. They said premium has to be 15% for a special policy, 10% for other policies. They introduced this new subsection which says aggregate of premium for all such policies in any of the tax years during the term of such policies is less than 250. Now let's say you have 4 ULIP policies, all are running simultaneously in the period, and aggregate of all these policies is 2,50,000 in any of the years. It does not say it has to be more than 250 in all years. So this drafting error had come about in the bill in 2025, where they had used the word in all of the tax years. I think then when the select committee sat, they realized that it has to be changed and has to be again congruous with the old act. We cannot make it all. It has to remain any to be in line with the old act. So they changed the wordings. So basically this would mean that if you have, let's say, 4 ULIPs running simultaneously and the premium for all these ULIPs exceed 2,50,000, then your policy will no longer be able to enjoy an exemption. This going forward again got amended after 2023. This again got changed for other than ULIPs. They said where the premium is for all your policies running exceeds 5 lakhs, 3 basically which was for ULIP and for other than ULIP increased by another 2 lakhs, they made it 5 lakhs. Then they said that because it is 5 lakhs now, so all premiums for other than ULIPs have to be kept separately, ULIPs have to be kept separately. Then the 2,50,000 similarly has to be found out for other than ULIPs, which will be 5 lakhs. Now because IFSC was the trend in the last couple of years, everything has been moving towards an IFSC. They want to promote institutions in the IFSC, banking sectors, insurance companies, stock exchanges. They went a step ahead to say the 250 and 5 will not apply to any insurance issued by a company in the IFSC. So that is a saving clause here. And these, basically when you see clause C 1 and 2, this has just continued from the old act. The old act also mentioned that a key insurance man policy will not be able to enjoy an exemptions. We will come to certain factors in a key insurance policy which are still under debate, even after an amendment a couple of times. And here very interesting when you read the note, even though 11 section itself had a saving clause saying that we will issue notifications wherever there is an issue. Again, there is a note here very specifically saying, for removal of difficulties, the board may issue guidelines with prior approval of central government which shall be binding on the income tax authorities and the SSE. And every guideline issued by the board under this clause shall be laid down before each house of the parliament. Ideally, this should be the process for every amendment, which is not required here, but again explicitly stated here. Ideally, this language should have been in 11 itself. It would have clarified for the entire schedule in one go, instead of placing it in one place. Now, we'll just come back to the issues. Now, is picking and choosing of policy for exemption is allowed or not is not explicitly clear. Because when you go through Circular 2 of 2022, which was issued by the government, they gave a couple of examples where they said you can pick and choose policies as per your benefit. But who is going to do that? Is the assessee allowed to pick and choose, or again the department can pick and choose? There is a lot of ambiguity as to, let's say a person has 5 ULIPs. And then there becomes an issue as to which policy to choose, how to choose the policy. This still remains even under the new act. Ideally, would have solved a lot of problems if they could have just simplified this a lot more further. But they have not done this. So basically, the challenges with respect to choosing which policy for exemption still remains in the new act. So basically, when I go ahead, I will call these as missed opportunities probably. Missed opportunities to probably set right something which could have been done, which has not been done. Now, there has been a lot of litigation surrounding a keyman insurance policy with respect to its assignment. It is clear that any company or a partnership firm taking a keyman insurance policy is allowed a deduction for the premium paid on the keyman insurance policy. But let's say when the keyman policy is assigned to whoever it was taken for, can the person then say that the keyman insurance loses its color and then it is converted just to a normal life insurance? Because the keyman insurance policy is nowhere defined. It is only defined under the act. So keyman insurance defines itself as a policy taken for one of the officials, whoever is working for you. Just simplifying it, somebody who is working for you. One person taking it for another person. So basically what happens when you assigning it is it does not fit in the definition anymore. So majority, a number of courts had stated that, look, when you assign it, it changes its color completely. It no more remains a key insurance policy. It becomes a life insurance policy, and thereafter it is available, and all the benefits under 1010D, even with respect to bonuses, will apply. So that's why what happened was then the government came back to say, no, I will introduce a specific clause to say keyman insurance policy, I will not allow. But as recent as 2020, I think 4, there was the decision of Mihir Parekh versus ACIT, which is the Delhi Tribunal, which said that I will still allow you the benefit of the keyman insurance policy on assignment will not remain will be converted into a life insurance policy. So basically, even as fresh as 2024, courts are still ready to take a stand that it is converted to a life insurance policy. This is basis only one statement. So the assessee had argued that basically the insurance policy was from LIC. So he took this policy when it was a proprietorship firm. So when he was a proprietorship, he had taken a policy for himself to say, I am the key man of the business. If something happens to me, there shall be a loss to the business. So let's take a insurance on me. So this going ahead, what happened? He discontinued the entire proprietorship business. So what remained was only him doing the business. So then he argued before the courts that the LIC itself has recorded that this policy has been converted to a life insurance policy. LIC Delsum has stated in the policy statement, this no more remains a keyman insurance policy. It has now converted into a life insurance policy. So on basis of that very statement, the court, even as recent as 2024, has gone on to state that no, it's become a life insurance policy, please claim a 1010D. This exemption was introduced on 1st April 2024. The assessee, which is the Mihir Parekh case, was for assessment year 16-17. So this is still after the amendment was taken place, and they still have gone ahead and given this benefit to the assessee, which is 1010D. There was another case which is Allu Arvind Babu, which was a Madras High Court decision which stated that no, because keyman insurance has been specifically defined, it does not convert itself into a life insurance policy because nowhere it is stated in the act that it will become a life insurance policy. They read it very literally. Then you will not get a decision. So basically now somebody wants to argue there are multiple options still available. So again I would call this a missed opportunity. Probably they have not plugged this. Also that this chance of somebody arguing on this probably is very stray. But again, when they have taken up such a big exercise, they have spent so much time on it, I think it was worthwhile to probably shut small gaps which are also there. But probably this has not happened for whatever reason. If required, can we take up a few examples on just how to check for exemptions on the ULIP? Can we go ahead? If time permits, we'll just take a couple of examples, not many, because they're close to around 10 examples which are given by the ministry. We'll just take up a couple just to understand very quickly as to how. We'll start with the very plain vanilla one. It says the date of issue of the ULIP was 1/4/21. The premium is 5 lakhs, sum insured is 50 lakhs, consideration received on maturity is 60 lakhs. So here if you see the sum insured is 10%, which is 5 lakh rupees, and it's issued on 1/4/2021. The act changed from 2013. Earlier 20% was allowed, there was no 2,50,000 limit. So the government itself says this is going to be exempt under 1010D because the policy was much before we amended it. So there are no problems here. So if you just read, we say maturity will be exempt under 1010D because the policy was issued before 1/2/21, before they changed the act. Now we'll take probably a double policy scenario where there are two ULIPs, A and B, both issued after 1/2/2021. The annual premium of one is 2 lakhs, the annual premium of the other is 3 lakhs. Sum assured 20 and 30 lakhs, still both the premiums are less than 10%. Oh, I'm sorry. I think the screen is frozen. Just a second. Yeah, we'll come to this, yes. So A and B, date of issue, again 1/4/21 and 1/4/21. Annual premium 2 and 3 lakhs. Sum assured 20 and 30 lakhs. Annual premium remains 10% of the sum assured. Both maturity happen in the year 31 together, that is 22 and 35 lakhs. Now they say B will not be exempt under 1010 since the aggregate annual premium payable for A and B exceeds 250. If you do 2 plus 3, in any of the previous year exceeds 250, therefore B will not get the exemption during the term. Hence, however, A shall be exempt under the clause since its annual premium does not exceed 2,50,000 any of the previous year. So basically, now this is not coming out from anywhere from the reading of the section, but what we will go forward and see is the government itself is excluding an insurance which is not satisfying the conditions of 1010D. So let's say because B is not satisfying the conditions, it is not being included in the aggregate amount. Because ideally even A should have been not exempt, because it is still crossing 2,50,000 for every year, because they're starting on the same date, ending on the same date. 1/4/21, ending on 31 on 1/11. But the government is going ahead with the premise, if something is not eligible for exemption, we will exclude that for limits. Because going ahead we will see, or else it will, the answer in the example will not make any sense. We will see this, we will take it in the 10th example, which is the last example given by the board. So this is 5, I think, extreme complication that can happen. So there are 5 things, 5 ULIPs, X, Y, A, B, C, 2 policies in 1/4/21, 3 policies in 22. So it's easy to knock out C, because the premium is anyways 3 lakhs more than 2. So C is out of the window. They say X and Y both will be eligible for 1010D, because annual premium does not exceed 2,50,000 rupees, the surrender value. Then they go ahead to say A, B, C will be taxable, clearly, because they say the premium of X and Y is already 2 lakhs. A, B, C included, everything is more than 250, it will cross. If you just add all the premiums, it is 1, 2, 3, 4, 450 plus 3, 750. So basically for A, B, C, all 3 years, they are not taxable. So that is why X and Y are becoming exempt. They are giving the least preference to X and Y because the sum assured is less. So they are not considering A, B, C to give the benefit, and only that is why only one, it is 2 lakhs the premium for X and Y. If you see, it is not exceeding 2,50,000 rupees. If we were not to exclude A, B, C, then the issue would become all 5 policy ideally should not have been exempt, because all policies are running together, all premiums are more than 250. They are excluding A, B, C and only then giving benefit to X and Y. So this is not coming about by reading of the section at all. It is very, very confusing if one has to just read the example with the plain section of the act. This ideally will require more clarification going ahead. So just to point out that the issues are still there, probably not completely solved. Hope I've not added to the confusion, but I've just brought it to your attention that issues are still continuing. Maybe a lot more work still is required in this front. And hopefully the same rules are not copy-pasted into the new act, and some work is done on the rules as well. Now we'll just head back to the presentation. Yeah. So 1011, payment from a provident fund. Again, similar limits have come into even a provident fund. Contribution is excess of 2.5 lakhs on or after 1/4/21. Contribution limit of 5 lakhs where employer cannot contribute. We'll come back to this. Contribution limit of 2.5 lakh for others. So the issue that might arise is timing mismatch between deductibility of tax and actual chargeability. Well, let's say somebody has contributed more than 2.5 lakhs or 5 lakhs. The interest therefore then becomes chargeable. So then the question comes as to, will a government department even deduct TDS in the first place? And when will it deduct TDS? When do I have to offer to tax? So all these problems are still there. Ideally, income will follow accrual basis. You will follow 145 and say, income is interest is ideally accruing every year. But again, because this is income from other sources, you may say, I will follow cash basis as accounting and offer only in the year of receipt. But TDS might then not follow it. So you'll have mismatches there. That might still continue. And also there a rule has been set in motion by the government, where they are saying that the provident fund authorities now will have to maintain 2 separate accounts. I think already there was a problem with maintaining these funds. Now they have added more pressure on the institutions to now say that the provident fund now has to maintain 2 accounts. One before 21, one after 21, and the one before 21 will have contributions which have not exceeded the limit. The one after 21 will have contributions which have exceeded the limit. Interest has to be computed separately. Where interest has arisen because of additional contributions, that has to be taxed. So a lot of confusion still persists, which ideally has to be solved. Again, these limits, now let's say they have said that the limit, contribution limit of 5 lakhs, where the employer cannot contribute. There is only one PPF where the employer cannot contribute. That is a public provident fund. Even otherwise, you cannot contribute more than 5 lakhs. The maximum contribution is 1.5. So it does sometimes one has to think as to why there is even a limit of 5 lakhs in the first place. Why was a limit of 5 lakhs? It's just causing unnecessary doubt and confusion in the mind of the assessees. Can I even in the first place contribute 5 lakhs? They could have just clarified to say only 1.5 is the maximum limit. If I'm wrong, somebody can correct me. Is it even possible to contribute 5 lakhs to a PPF, where employer contribution is not there? As per my limited research, not possible. So therefore, still these confusions still persist, which are ideally not required. Now the TDS mismatch has slightly been, the issues surrounding that have been reduced because the government now realizes that an assessee offering income as per the sections of 199 will offer income in 1 year, somebody might deduct TDS in the other years. They're allowing you to file an application to kind of align them so it's easier for you to either carry forward or claim it in an earlier year. So to that extent, there is some flexibility, but still there was no requirement for these issues to even arise in the first place, to something as simple as a PPF. Now, payment from accumulated balance in a recognized provident fund, this has its own challenges again, because now the provident fund is covered by another piece of legislature by itself. The Income Tax Act draws its taxation from that act. Now, EPF interest is exempt up to retirement. Therefore, thereafter it is taxable. Now, various cases have happened. In a case of an employee of Wipro, it was the Dilip Ranjrekar, which was a Bangalore ITAT case, which was again affirmed by the High Court, where it said only up to the date you are working for the company can you be called as an employee of the company. Anything you get as interest from that PF, you will be exempt only till you are a part of the company. Once you leave the company, you have to offer it to tax under other sources. There are a couple of other decisions also to say, let's say you even resigned from the company, but until the control of the PF is still there with the old employee, let's say you don't withdraw it, it is still there, there is a straight chance that you may still go and say, no, I will claim the exemption which is there because the fund is still with my old employer. But ideally, courts will not agree to this because there is no employer-employer relationship anymore. Claiming this as salary will be very difficult. You will have to offer it at other sources and then pay taxes on it. We'll move to the next one. 1011A, Sukanya Samriddhi, I think no major changes. It continues to be similar to PPF, which is the exempt model. Everything which goes into the fund and which ultimately comes out of the fund is exempt throughout. And Sukanya Samriddhi is basically the funds are just kept in a savings bank account which is run by the government. So they are exempting this through and through. Basically no difference between a PPF and a Sukanya Samriddhi. This continues. Now 1012A, NPS withdrawal, no change. However, a clarificatory circular may be issued to state that payment out of credit of NPS which is not claimed as a deduction. So basically they say they have capped it to saying if you have claimed deduction of certain portion of NPS, only 60% of that is ideally what you will get an exemption for. So they have not there again said that what you have not withdrawn, that we will not consider as to compute the base for 60%. So again, there is still some ambiguity there. It will help actually because a lot of salaried employees, let's say even though they are not claiming deductions, are still going for an NPS and they will withdraw this at some point. So it will help if they just clarify to a certain extent to say what you have not claimed as a deduction will not be considered as a base to compute the 60%. So these things are continuing in all NPS accounts. So this problem will persist going ahead. Sorry, sir. Yes, sir.
Whether the old scheme and new scheme continues?
Yes, sir. The old scheme and the new scheme continues. Again, probably 2 years down the line, it might so happen that what I'm speaking today is completely redundant because none of these exemptions continue. But for now, until both the schemes exist, some of these will continue to exist.
No, if I have to file the return under
Yes.
new scheme,
Yes, sir.
these exemptions
No,
will
sir.
not be there.
No, sir. No, sir.
Then why in the new act it has been?
Sir, because there is option to opt out once. So still there are probably high net worth individuals who are claiming HRA or other allowances which are much higher who are still opting for the old regime. So probably you will see 3-4 years down the line they will make a forced change where everything moves to the new regime. Probably because this is a transition and it's been only a couple of years since they've given an option. This will continue in my humble opinion. And probably going down the line, we will see everything just being weeded out. So to make it a lot easier. like I said, what I'm discussing today might absolutely be redundant even 6 months down the line, or even 1 year or 2 years down the line. But I think, but the principles which will come out from this will help us going ahead. Agniveer corpus, again, no big change. And also the applicability of this is still to a specified group. So they have not touched the language as of any sort, and there are currently no issues arising right now because it is still new. It will still take a couple of years for issues from this to arise and then go to courts or issues to come about. So basically no jurisprudence on this yet, and active application of this section probably is yet to start or just started. So there are no real red flags here. Superannuation fund, no major changes. However, clarification has to be stated just to make, because you have taken up a challenge or you have taken up a cause of making it more simpler, you just have to state that resignation is not considered, only retirement. So because courts, matters are traveling to court very often to state, I have resigned, my superannuation has to be exempted. Courts again have to say that no, resignation is not equivalent to retirement. They are two different things. I will not give you an exemption for superannuation. Now, scholarships ideally are exempt. Now, going ahead, we will see a lot of impetus from the government, because all of now everything, the government is also pushing for a lot of research to be happening in India. They don't want to push a lot of things in there. So you might see an impetus to a lot of learned people to continue the research in India. You might see a lot of scholarships coming out for, let's say, students, a lot of professionals already. So we might see some litigation in this side as to what is the cost of a scholarship. They say anything towards the scholarship, any cost incurred towards education by a student is going to be exempt. Now, who is a student, what are the costs in a scholarship, all that has not been defined even in the current act or the new act, because again, I think they have felt that not a lot of people are availing a benefit under this, so they have not. But still, again, a couple of issues still persist in this. A student, therefore, we can say that all of us are students as we sit right now. Me, you, I think all of us are still learning. So even let's say a PhD holder gets a scholarship to do a further research, he will still be called as a student for the purpose of the scholarship. And what are the costs for a scholarship? I don't think merely we can curtail it to only education. Basically, courts have held that even travel costs relating to a scholarship forms part of the cost of the education. So they have gone to the extent of saying even those will form part of the cost of the scholarship. Then the currently cost of travel has not been included. It is not mandatory that the entire scholarship has to be spent on the exemption. Let's say I go to the US tomorrow. I've been given a scholarship. I've been very frugal with the scholarship. I've been able to save some. Now, can tomorrow the government come and tell me, no, you have saved some, you pay tax on it? Not possible, because it's probably because you were frugal, you were able to save something. But the act does not, or the jurisprudence does not wish to tax this. Now, I had a doubt during my articleship whether my stipend is taxable or not. Actually, I looked a lot at that time but couldn't find any case law. But today I have an answer for myself. That article stipend is not taxable, it is exempt. There's a case law by the name of Sudhir Kumar Mishra versus the ITO, where it's clearly stated that even an articleship stipend is a scholarship towards the cost of education. It is still exempt. Now, going ahead, 1017A, and there are a couple of the other sections in the erstwhile act, that is 15.147, 1033, 12AA, 12AB subclauses, deal with probably issues which are not dealt with very regularly. Something like a local authority, then municipal authorities who are probably giving services in the local municipalities. Such sort of institutions are covered here. No major change there. Probably no litigations are going to happen on this end because they're all government authorities. You don't want to unnecessarily initiate litigations here, though. So not much to discuss here. Now we will move to Schedule 3. Schedule 3 now is for an eligible person. We'll begin with section 10.2. Now again, like I said earlier, there is no continuing numbers given. It again starts with 1 for the third schedule. Now this deals with section 10.2, which is any sum received from an HUF. Now, They say that save otherwise anything in 99(3) and 4, that any income received from an HUF or any income received from an impartible estate of an HUF is going to be exempt. But again, if you go further deeper into it, 99(3) and 4 still has some language changes with respect to the old law, which are ideally again not required, but for good or bad, they have done those changes. We'll just go through quickly to 99(3) and 99(4). So 99(3) is where a property owned by an individual is converted into property belonging to the Hindu undivided family with a member through the act of impressioning such separate property. So the problem here starts right now in A itself. The starting words use converted into a property. So they've just mentioned what is a property. Now when they come to A, they for the first time use the word separate property, which separate property has never been used earlier. They have only used property, converted into a property. A says separate property. So because separate property was used in the erstwhile 64(2). Through and through, the word separated property was used in the earlier section, which has now again been, I think, slightly changed because they've used multiple words here and there. Further, if you come and see A, I will run through this very quickly because I know an esteemed panel further going will discuss this in detail. Just touch upon this and go ahead. They say the act of impressioning such separate property, again, which is not defined, with the character of property belonging to the family. They have not used the word family again everywhere. They start with saying belonging to the Hindu undivided family. But when you come to A, they use only the word family, so then we have to just presume and go ahead. It means the HUF. Then there is B and C. Then they have separately culled out to say without adequate consideration. Then irrespective of any other provision of this act, this following will follow. The earlier act did not have the words without adequate consideration separately. It was a continuation of the third limb, which says transferred directly or indirectly to the family without adequate consideration. Now what they have done by this is, they have not qualified the C limb only. They have qualified ABC, all three together. Now ideally it is not possible for somebody to pass off his personal character as a family character without adequate consideration. It cannot apply. The without adequate consideration cannot apply to A and B at all. It can only apply to C, which was there in the earlier act. But now because of the placement, things have changed. Ideally, this third limb should have only applied to C, which was there in 64(2) of the earlier law. Now because of the placement of the sections, now probably this has become more stringent than what was required. Probably not intended, but that's what the section says now. But otherwise, the rest remains the same. We will just move quickly back to the presentation. Yes. 10(2)A, which is dealing with the share of profit from a firm. No simple change. Actually, they have simplified the language a lot. It was probably a 6-sentence or a 5-sentence definition for what a PSR means, which now clearly has just been stated that profit in the PSR ratio will be exempt. Before it stated your total income with respect to your profit sharing ratio in the deed, which was very complicated, which they have very rightly reduced to only a single sentence to say anything you earn from the partnership firm in the PSR ratio, which is mentioned in the partnership deed, is exempt. As simple as that. Nothing to change. Probably a very true to character amendment this has been made. Now 1010BC, basically this was any amount received by the SSC or his legal heir on account of a disaster. Disaster has already been defined in the Disaster Management Act. It can be an act of nature or a man-made act which causes grave injury, etc. to the SSC. But they have made probably a very small error here. It states that the exemption is granted only if no deduction of an amount was claimed under this act. It is probably, let's say in a transition phase, somebody would have claimed a deduction in the earlier act. It is impossible for somebody to claim a deduction under this act. So you might then say that this is not applicable to me at all. Because I claimed it under the old act, not under the new act. I will still claim an exemption under this act. So this might still continue under this act. This ideally was also a part of the ICAI recommendations which went to the select committee that this should have been changed to that tax year or the erstwhile 1961 act. But this has somehow been missed and still remains the same. Probably going ahead 1-2 iterations, you will see this also changing. Sorry if I'm moving a slightly fast because there are a couple of clauses to probably touch upon. I would like to touch upon most of them so that we don't miss out on anything. If I'm going slightly fast, please let me know. We will slow down where, in case you feel that we have to place some importance to. 1012B, payment of NPS, no change. This is the new provision again introduced for partial withdrawal. There was no section for a partial withdrawal. A new section was introduced under the erstwhile act itself. This continues again in the new act for a partial withdrawal, which says up to 25% of whatever you had contributed will remain to be exempt for whatever reasons you have withdrawn it, either as a guardian or an assessee himself. 1017.1, now this is very, very interesting. I will come further when we go into 10.5 and other special allowances which are given for employees and other exemptions which are there in the act for, let's say, a child allowance or a hostel allowance, etc. All of them are still at the same limits which were there about 25, 30, 40 years back. It's 900 rupees a month, 1,500 rupees a month, 1,500 for a child. Those are still remaining. Now, these 17.123, which is of the old act, all of them relate to allowances given to MPs or MLAs. Very, very interesting amendment. Daily allowance to an MP, MLA, there's no change. That's fine. Allowance to an MP, now they have a specific inclusion to an act. They say inclusion is basically they have given a reference to salary allowances and pension of members of Parliament Act 1954. This was not there earlier. If you just go by what is the current daily allowance given to them, if the salary currently is fixed at 1.24 lakhs for every member of Parliament, the daily allowance is 2,500 for each day of duty. Whereas other assessees or salaried employees who are working are getting 900 rupees a month. So basically this gap still continues. They have used this to their own advantage. Because most of the members of the select committee were also members of Parliament, so you can see why this has happened. We go to an allowance to an MLA, again, still no change. It still continues to be the same. But allowance to this 1017.3 is an allowance to an MLA, which is a constituency allowance. Currently, it is 64,000 rupees a month in Karnataka. And this they have amended to state that a state legislature will apply. So state can do anything it wants. So if the state legislature keeps amending itself, they will keep getting increasing limits as they go forward without any curtailment in the act. Whereas the lot of allowances, I think over the period, a lot of bodies, even assessees, have been requesting them to come to line in the current scenario, current living cost, but that has not happened. But it has happened on the other side, rightly or wrongly. Now, leave travel allowance. Very interesting, probably not going to be applicable to a lot of assessees because I think most of them will now move to the new regime because the current tax regime is very, very beneficial. Up to 12 lakhs you're paying ideally no tax. But the saving is probably a lakh or so in terms of taxes. Leave travel allowance for somebody who's still claiming, let's say somebody has a high HRA or a lot of other deductions, ATE, education loan, will still claim an HRA, will still claim an LTA. So we'll just brush through the changes. There were basically some COVID-related changes which were made to LTA, which said that a cash allowance was given, one-time cash allowance, which said that you can spend it up to on any GST product of 12% or higher, 36,000 per member of the family, or 1/3 of the total expenditure, whichever you are spending. That the maximum limit will be that. Now, because COVID was over, this is no more applicable. This was rightfully removed. Now, but they have still remained. They have still kept the words taxable on receipt or due. Now, there still remains a dichotomy today because 192 still says that the erstwhile act says salary is taxable or TDS is deductible under 192 only on payment basis. So basically, when an LTA is very difficult to be on due, I don't know how it is due. It is always paid. It cannot be kept due, or somebody cannot be given LTA on due basis. So probably this can be changed going ahead. Only actual fare is allowed. Incidental expenses are not allowed till now. So probably no guidance on this going ahead. There's a very, very complex computation mechanism for this. Because let's say you're traveling by air, you have to take a first class fare of a national carrier. Now there is no national carrier also. We don't have Air India anymore. There is no more national carrier. I don't know how they're going to estimate what is the first class fare of a national carrier. We don't have Air India anymore. Then there were a lot of issues which were troubling the employers because now an employee might say, I have not gone outside India. I have only used this for travel within India, where in case he would have actually gone outside India. And when it comes to a assessment, then the department comes to know he's actually gone outside India. So therefore, there is a 201 risk which is always over the head of the employers, and has been held in multiple cases where the employer has been brought to task for not deducting the right TDS for as big as a company as Larsen and Toubro. So that has also happened. Then then you are given the allowance for the shortest route. Now who computes the shortest route? What is the shortest route? All that still persists. There is also a possibility that going ahead, because there is a lot of hue and cry from the industry as well as the SSC, that a lot more deductions have to come in for a salaried class. They will probably increase the standard limit, or they might get in a lot standard deduction as such, or they might increase, like probably provide for an allowance or a travel allowance or a one-time allowance for once a year. It might happen. If that is so, and if a travel leave allowance comes, I think they should ideally address all this. Section does not require the employee to take the shortest route, but allowance is as per the shortest route. So all this has led to a lot of litigation. Now 10(7) is allowance paid to citizen outside India. So basically, if the government pays any citizen of India for any of its services outside India, it's not going to be taxable, fair. Now 1010cc, non-monetary perquisite, basically, for example, an expat, let's say, who comes from outside of India to work in India. Let's say, so how these expats generally work is, they say, I am not going to pay your taxes in India, I don't care. I want my in hand in India, you bear all my taxes. So this was happening, this is still happening. The only change here is, then earlier there was a reference to section 200 of the Companies Act 1956, which stated that ideally you cannot jack up the salary of an employee of a company by taxes, by tax-free payments. Basically, you cannot take an exemption for 1010cc, but this was under the old 1956 Act. 2013 Companies Act does not have any provision like this. So they have rightfully removed the reference to this entire thing, and now 1010cc is probably available in its new color also. Any doubts? I'm sorry. 1013A, house rent allowance. I think this has been a point of contention for a lot of salaried employees. I think no major change in the provision. Yeah, thank you. So no change, but a lot of issues still remain. I think non-inclusion of metro cities like Bangalore, Hyderabad, Pune, I think where the rents are already sky high. I think the salaried employees are still getting 40% of their basic as a deduction. I think this has been an ask, a request, a prayer for a very, very long time, which has still not happened. They got a chance to do it, but they have still not done it. Then issues relating to joint ownership, I think a very, very interesting point. They say if an employee is staying in his own house, you cannot get an HRA. Now let's say I am co-owning the house with my wife. Can I still claim an HRA? This issue still persists because a lot of courts have held that joint ownership does not mean absolute ownership at all. This Supreme Court case law, which is in state Banarsi Das Gupta, which is an old case law 166 ITR 783, which says joint ownership is not akin to an absolute ownership. So basically, if you're a joint ownership, then you can say that I am not living in, I don't absolutely own the house. I am living in the portion which is co-owned by my wife or my brother, and he lives in the portion which is co-owned by me. But again, there is an issue because Karnataka High Court in MG Shivani has somewhere said that, which is again in the context of 54, where the SSC argued that co-ownership is not akin to absolute ownership, but no, Karnataka High Court said no, nothing doing. Co-ownership is absolute ownership only. You are still owner of some part of the house. You own a house. So you will not get 54. But then again, there is a Supreme Court case law. Then again, so unnecessary litigation is still possible if this continues. Language issues. Now, if you ideally go through the current HRA, the first clause will say that any sum which is actually spent on rent will be allowed as a deduction. Then again, the fourth clause again comes back to say that what is actually spent only will be allowed. So probably the fourth portion was not required. They've just repeated it. That could have ideally been removed and not kept in the act. 14, special allowance, no change. This is basically any allowance given to an employee which is used in the course of business. They use three words which are very necessary: wholly, necessarily, and exclusively. Now this is much more stringent than 37, which uses wholly and exclusively for business. Now this 1014 uses wholly, necessarily and exclusively. Now under the erstwhile 15 BAC, most of the exemptions were gone, but you were still allowed to claim 1014. 1014 is still available even under the new regime. 15 BAC is still available. So there are a loophole still exists here to say that now what is wholly, necessarily and exclusively for the purpose of earning business. Now the department might clearly say this is not necessary for the purposes of carrying on your duties, while the employees say no, it is necessary. So the litigation still exists. Okay. And now going to 1014.2, now this is basically like a residual allowance which is given to all the employees. Now moving to the current age, and also because it's the 2025 Act, they have still not considered something as a work for home allowance or furniture allowance required to make your home an office. Because all this was actually done by a lot of multinationals. They actually paid you money to get furniture, to get a nice chair at home so that you don't have a backache. You can work like 14 hours a day in sitting in front of a laptop. You have an AC to make yourself comfortable. So all this was done, but this still was not kept in mind in today's scenario. Hello, yeah. So they have not rejigged any of this, and because this is still available under the new regime, no such allowances has been given. All they say is as may be prescribed. I don't know what is going to be prescribed. So ideally it would be very, very helpful if all these new aspects are taken into consideration when the actual allowances are prescribed, which are ideally claimable under the new regime. For example, if I would just say education allowance is only 100 per month per child, which ideally is non-existence because today a book costs 100 rupees. So a child allowance for 100 cannot continue any longer. And a hostel allowance is still 800 rupees a month for a child. So all this probably needs a revisit. We might see changes going ahead. Now 1018.1, 2 and 1019 basically deals family pension for somebody like an armed forces who's been given a Veer Chakra or some other accolades. Any pension received by the family, by the widow, by the legal heirs is exempt. So nothing to discuss much here. Again, 1032 minors income going to be clubbed after 64(1)(a) of the earlier act. Now has moved to section 99. It says 1,500 per child. If I just keep funds of about 50,000 today for 1 year, savings interest is more than that. 1,500 again, not commensurate with today's world. They have again got a chance. I don't know if the intent is to give you still 1,500 only, or they've just forgotten and they wanted to basically only focus on reducing the words and making it more concise. No change. I think a new portion has been added in section 99, which says any amount where the work has been done by the child. Now the question again is, can a work even be done by a child in the first place? Is there an issue there? Can a child work? So more clarification is required as to work is work done by a child. What does it mean? Does it mean manual labor, or does it mean going and playing cricket, or going into a singing show? What does it mean? Because all those are again covered by, let's say, expertise, technical knowledge, or talent of the child, etc. But work done, I don't know why that was required, because this was not there in the erstwhile law. They've included something called a work done now. Now, 1037, transfer of an agricultural land. I think I have been grappling with the issue as to advise my clients or myself understand what is an agricultural land which is exempt under the Act. I think there was a very confusing portion where they said where your population is less than this much, you are this many kilometers from the municipality, then it will be a rural agricultural land and that is going to be exempt. Now they have tried to somewhat simplify this by a simple table, which is there in 222, which is there in the definition itself. There they have given population in one column. They have given the distance from the municipality in one column, which has made it much, much simpler. But I think one thing could have very clearly been done. There is a circular 36 of 2016, because this section also deals with any compulsory acquisition of any agricultural land or not, or other than agricultural land also. Because there was a circular 36 of 2016, dated 25/10/2016, which clarified that compensation received in respect of any award or agreement which has been exempted by levy of the Income Tax Act by Section 96 of the Reflector Act, which is basically where the government used to pay any compensation under the Reflector Act. So for any compensation, no TDS was ideally required to be deducted for any compulsory acquisition, even of a non-agricultural land. But no, again, no mention of this here, because it's a circular which has been given by the department itself. It would have helped a lot if they would have just mentioned this here. 1026, citizen of a particular state. So basically, the northeastern states, Sikkim, Meghalaya, Assam, there are a lot of things which are continuing from, I think, time immemorial. They're continuing. They don't want to disturb this. Then again, 10T to 23 serial number, the various sections, basically 1026 AAA, 1030, 1031, 1020, 1021. Again, probably a local authority, a board or a trust, which is established for, regulating certain matters. These are what are dealt with here. 1023A, that is income of an institution established for a profession of law, medical accounting, basically our very own ICA or an engineer's institute or the legal medical council, something of that sort. When an approval is given to them by the government, and any income earned by them which is applied to the same purposes was ideally allowed an exemption. And if the approval was removed, erstwhile section 1023A provided them with an opportunity of being heard before an approval was going to be taken away from them. But the new act has very silently removed this option at all. There is no opportunity of being heard anymore. So basically you can say that these provisions are therefore taking away the basic the rights of the taxpayer, which are already there in the taxpayer's charter, where an opportunity of being heard is required all the time. But again, for 1023 and B, if you see, basically, which is the khadi production, any society which is doing any production for khadi, no opportunity of being heard before an approval is cancelled. So basically, if the government thinks you're not doing the right thing, cancelled, no option given. These might have ramifications when you do a 12 AV registration or a registration under ATG, because it says if there is an infraction of any other law anywhere, you will not get a registration. And if they are cancelling this without a hearing or without an opportunity of being heard, it might cause unnecessary circumstances which are not required for. Yeah. Again, a lot of section 1023 DA, 1023 EA to EE, 1024, 1025, 1039, 1042, 1043, 1046. All of them are relating to, again, like I would say, some local authority or some authority which was required to be given an exemption because it was doing work for either the government or the public. And these have to be continued. If they are not continued, then those institutions would have faced an issue. This, I think, can be just referred on a glance. I think in an everyday practice, ideally, this would not be something which we would apply. So I'm not touching upon it. Now, with respect to non-resident, this is the third bucket, which is Schedule 4. There was first bucket, which was Schedule 2. Second bucket, which was Schedule 3. This is the third bucket, which is Schedule 4. This deals with only non-resident exemptions. 1042, which is NRE interest, no change in the section. There were some issues in relation to, let's say, an NRE account is joint account held with both joint account holders receive an exemption for the interest in that account. Plus, this account very specifically requires you to be a resident as per the FEMA guidelines, and does not require you to be a resident as per the Act. And how it works under FEMA is, if today you have an intent of moving to India permanently or moving outside India permanently, on the day of intent you become a resident or a non-resident. You don't have to stay in India for, let's say, 182. Let's say today I come to India and say my intent is I will move outside India immediately. Then you become a non-resident on that very day for FEMA purposes. Whereas you might stay for some time in India for income tax. So these are issues which are there, which probably I think don't require a lot of clarification, because I think more or less settled. Then remuneration received by officials of consulate diplomats. Again, they don't want to change this because this is settled, no issues here. 10.6, there is start share exemption for somebody of a foreign enterprise. Any remuneration given for somebody who's working for a foreign enterprise not engaged in a business in India. If you don't stay for more than 90 days in India, you are going to get a exemption. Such remuneration should not be deducted from the income of the employer, which is chargeable to tax in India, if any. Then there is 4 to 14, again various non-resident sections. For example, somebody is doing an oil storage facility in India, somebody who's extracting oil out of India, somebody who's part of a ship, cruise ship, which is coming and going outside India. So for all such cases, mutandis, mutandis, whatever was there earlier is continuing, no major shift here as well. Again, business, trust, REIT, InvIT, all these are very, I think, fresh and new provisions. I think REITs and InvITs have now started to take an uptrend and have started being favored by a lot of investors. So they don't want to disturb any section in terms of any new conditions or breaking down the old conditions. None of that still exists. I think it is quite simple right now with respect to, let's say, for a REIT is still a pass-through for any rental income. It is taxable only in the hands of the unit holder. That still continues. Similarly for InvITs, all the exemptions or all the benefits which were there earlier have been moved on. Even the new act, they don't want any error in the drafting. I think they were very settled with it. This continues. Then again 23F, FA, FB, FE, FD, all in relation to again embassies and officials thereafter, so on and so forth. IFSC, again there are a lot of factors with respect to an IFSC. For example, let's say an insurance or any unit's capital asset referred to in a certain section, sold on a recognized stock exchange, which is there in the IFSC. A lot of other IFSC related issues have been just carried forward. No real big change. I think also nothing to discuss much on this aspect. Now there are certain transition issues which might still happen, and I know this session also is going to be taken up by one of the esteemed panelists who are going to come in the further weeks, coming weeks. We are going to discuss on this, but I'm just going to casually touch upon this because I feel that the discussion will be incomplete if I just don't touch upon it. Just touch upon it, not in much detail. Then transition available only for provisions or proceedings which have been initiated under the old act on or before 126. So let's say something has been initiated after 1.4. There's going to be an issue. You might not get certain savings which were there in the old act. There's still a problem there which might happen. Let's say set off of capital gains. What has happened is, under the old law, only short term was eligible to be claimed with long term. What they have done under the new act in the savings, which is dealt with section 536, they have not given any such demarcation. If you just read it now as is, you will feel that everything is allowed to be set off against everything. So that those issues still there. Section 10 sunset clauses, let's say now somebody is in the fag end of their 10AA, they're putting everything to a reserve. And let's say tomorrow I don't use the reserve for acquiring a plant and machinery. Ideally that has to be offered to tax. But under the new provision there is nothing to deal with this. So tomorrow let's say I don't use a reserve for buying any plant and machinery. Tomorrow the SSC might clearly say that there is nothing in the new act. How will you tax me? So those issues will still continue. Now let's say there is a certain repeal or a saving in 536 clause G. This proceeding relating to the old law, basically let's say there is a proceeding relating to the old law, but it is completed after the new law act comes into the force. So they are saying that the interest and the interest on the refund or the interest under any other provisions will be as per the new act, which might be beneficial to the assessee or not. Ideally, what should have been stated that it should not be something which is detrimental to the assessee. If it is relating to an old proceeding, the old interest and the old penal consequences should ideally follow within the new act. This has not been done, and the repeal provisions have been very loosely worded. So therefore, might be a lot of issues when we see transition. We might see a lot of issues in the first year. Also, there might be a certain issues because now they have removed the word notwithstanding from throughout the act. You will not see one place where the word notwithstanding has been used. They have now used irrespective of. Now this might cause an issues because irrespective of is much wider than notwithstanding in itself. And plus notwithstanding has now reached a certain level of finality because there have been n number of cases now by Supreme Courts or High Courts now to say what notwithstanding means. Now again, when you get irrespective of whatever is contained in anywhere else in the act, this might open a new Pandora's box again, which is ideally not required. And now everybody understands what the meaning of notwithstanding is. Probably they're not required to ideally change this, but still has been done. Then there's certain other issues with related to maintenance of books of accounts, etc., which still persist. I think which will be taken up in much detail in the other sessions. So I would like to conclude my session here. If there is anything I could clarify for somebody, or if there is anything which I have missed, which can be addressed by any other speaker, I think the floor is open. If not, we will conclude. We can conclude? Yeah. Thank you so much. Thank you so much.
Thank you, sir, for the wonderful session. On behalf of managing committee members of the Bangalore branch, ICAI, and members present here, I thank for the wonderful session and present a memento as a token of appreciation. Thank you, members, for the patient hearing. We'll meet on next Saturday for the continuing the same. Thank you.